Let's shift gears and talk about qualified retirement plans. These plans satisfy the requirements in the IRS code for tax-deferred treatment and the Employee Retirement Income Security Act, ERISA. Instructor, one option for Pearl to consider is opening a traditional individual retirement account, IRA for herself, and a spousal IRA for Dawn. If Pearl earns $100,000 per year and contributes $6,000 to her IRA, her taxable income for that year will be reduced to $94,000. If she contributes another $6,000 to Dawn's spousal IRA, her taxable income will be further reduced to $88,000. The money in the IRA can be invested and will grow on a tax-deferred basis. Pearl won't owe taxes on the contributions or earnings until she withdraws the money, typically after age 59 and a half. Note the annual contribution limits to an IRA increase each year. In contrast to a traditional IRA, there exists a Roth IRA. With Roth, the contributions are not tax-deductible. So if Pearl earns $100,000 and contributes $6,000 to a Roth, she will still be taxed on $100,000. The beauty of a Roth, however, is the interest credited to the account is never taxable. Instead of tax-deferred, it is tax-free. When she withdraws the money after age 59 and a half, she will not owe any taxes. Another retirement savings option is a tax-sheltered annuity, TSA, which is designed for employees of nonprofit organizations like schools, charities, and associations. Employees can contribute a portion of their salary to the TSA on a pre-tax basis, similar to an IRA. The contributions and earnings grow tax-deferred until the employee withdraws the money, usually after age 59 and a half. For self-employed individuals and unincorporated businesses like partnerships and sole proprietorships, a Keogh plan, now known as an HR 10 plan, is an option. Keogh plans are not available to corporations. Contributions to a Keogh plan are tax-deductible and can be up to 25% of the individual's net earnings from self-employment. Like IRAs and TSAs, Keogh plan contributions and earnings grow tax-deferred until withdrawn. Let's shift gears and talk briefly about non-qualified retirement plans. Non-qualified plans are not subject to ERISA rules. They can offer additional employer-sponsored incentives for high-ranking personnel and key executives. If Pearl's employer has contributed the maximum allowed under the qualified plan, and they would like to reward her even more for hard work, a non-qualified plan is the way to go. Instructor moves on to business uses of life insurance. Finally, let's explore some business uses of life insurance, starting with buy-sell agreements. Instructor provides an example of a buy-sell agreement. Imagine that Steve and Tracy are equal partners in S&T Enterprises, a business worth $1 million. Each partner's share is worth $500,000. If either partner dies, the other partner could end up in business with the deceased partner's family, who would inherit their share. To prevent this, Steve and Tracy can set up a buy-sell agreement funded with life insurance. Instructor explains the cross-purchase plan. Under a cross-purchase plan, each partner buys a $500,000 life insurance policy on the other partner. If Steve dies, Tracy will receive the $500,000 death benefit, which she can use to buy out Steve's share from his family. This way, Tracy can continue running the business without having to partner with Steve's heirs.
But do I have an insurable interest in Steve's life?
Great question, Tracy. Yes, you do have an insurable interest in Steve's life because you would suffer financially if he were to pass away unexpectedly. An alternative to the cross-purchase plan is the entity plan. In this case, S&T Enterprises itself purchases life insurance policies on both Steve and Tracy. If either partner dies, the company receives the death benefit and uses it to buy out the deceased partner's share from their family. Instructor explains the stock purchase and stock redemption plans. If S&T Enterprises were structured as a corporation rather than a partnership, they could use a stock purchase plan, which functions like a cross-purchase plan, or a stock redemption plan, which operates similarly to an entity plan. Another important business use of life insurance is key person insurance. Let's say S&T Enterprises has a highly valuable employee named Rose, whose contributions have been instrumental in the company's success. If something happened to Rose, the business would likely suffer. In this case, S&T Enterprises has an insurable interest in Rose's life and could purchase key person insurance on her. If Rose were to pass away, the death benefit can be used to search out and find a replacement for Rose. And I know, Rose, that is going to be difficult because your excellent work is going to be difficult to replace. Once they find a person, they're going to have to train that person. The amount of money that they were accustomed to making is no longer being made because a lot of clients came to them because of Rose. Some clients have stopped patronizing S&T Enterprises since Rose is no longer there. The life insurance they have will help buffer the bottom line. Typically, positions such as Chief Executive Officer or the Chief Financial Officer are prime candidates for key person life insurance. Great job on completing this video. Now it's time to test your comprehension of the concepts we just discussed. This video corresponds to ICAP quiz course number 38. Remember that number. Click the link in the comments section to access the Insurance Class Assistance Program, also known as ICAP. Once you're there, look for quiz course number 38. This quiz will help us see if you truly understand the material and are prepared to move on to the next video. Don't forget, ICAP quiz course number 38. Good luck and keep up the great work.